in just 15 hours. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, shocking news will go global the moment it's released. I'm going to show you what's coming tomorrow morning and why this news has political elites and investors from all around the world on edge. Plus, the experts can't figure out what's wrong with the U.S. labor market. I'm going to show you the truth about the problems facing the U.S. economy today. Now, let's head over to Bloomberg, where we picked today's story up with a headline as gold slips before key U.S. jobs data that may impact the Fed's decision. And this is absolutely critical because tomorrow morning we get the non-farm payroll report. And this has massive implications because global leaders are watching this report because they're seeing their economy slow down. We look at Asia, we look at Europe, and we continue to see a slowdown as those economies are headed right into a recession. And then we look to home and we find out the manufacturing sector's been on an 8-month decline. And right now the focus is, can the United States consumer come back, and can we see employers turn the economy around? Because if that happens, then it's going to be a big relief for global leaders who are looking for the U.S. to pull the rest of the world out of the slowdown. But that's not the only issue that this report is based on, and it's everything to do with policy and the Fed, who meets later this month. If we get the right number, it means they cut. If we don't, it puts them on pause. Again, everything is critical that comes tomorrow morning when we see the non-farm payroll report, because economists estimate that the U.S. non-farm payrolls due tomorrow morning rose by around 218,000 in November, rebounding after two hurricanes and a now-ended strike that lowered the October numbers. So what we're seeing is hope that these one-off events drove a massive amount of unemployment, and now that the storms are gone, now that the strikes are over, that employers are going to get back to hiring and putting people to work. And that matters because if people are working, they're likely out consuming, and that's what the world needs right now, is for the U.S. to do what it does best, and that is consume goods and services from all over the world. Because if we can do that, well, we can possibly see a turnaround. But if we get a weak number, well, watch out. The jobless rate is seen unchanged at 4.1%. Keep in mind, this was the high bar that Fed Chair Powell said he didn't want to see go up anymore. The payroll figures are the next major data release before policymakers meet on December 17th and 18th. And we're seeing the market price at a 25 basis point cut. This I completely agree with, but I'd love to know what you think. Do you think the Fed's going to cut on the next meeting? And if you do, weigh in the comments, how big's the cut going to be? Or do you think they're not going to cut? Give me your reasons why. I'd love to know, because when we look at the federal funds rate, it does matter what's going on with the labor market. Now, we hear from the Fed that they're not worried about inflation anymore. They actually believe that's going to come down at some point to their target. They're really concerned about the labor market. The problem is they're not reacting to what's really going on here. When we look at the unemployment rate shown in red against the federal funds rate in blue, what we can see is as the unemployment rate starts to rise, well, the Fed doesn't actually do much. You look back here to late 80s, and they're still raising rates thinking that the labor market's too hot. And the next thing you know, the unemployment rate continues to rise and the Fed is aggressively cutting. Then we move forward to the dot-com bubble in the year 2000. We see the unemployment rate bottom and start to rise. The Fed stays on pause, and then they're in aggressive cutting mode. And look at the global financial crisis. We learned nothing from the prior recession. You see the unemployment rate rising. The Fed's on an extended pause until they realize it's too late and they're behind the curve. And look now, we've been seeing the unemployment rate rise. Fed Chair Powell says, no, it's not going to get over 4.1%. And look, they're not cutting enough. And that's, of course, if you actually believe that the Fed has power over the labor market. Now, they believe there's something called the neutral rate, where if you bring interest rates to just this perfect level, the economy still grows at a rate that doesn't create rampant inflation, nor does it lead to a recession. And that's what they're looking for. Of course, we know there's no direct correlation between the funds rate and employment. What we can see is the Fed reacts to the economy. That's the risk here. If we continue to see more Americans hit the unemployment line, and that's what the manufacturing sector is suggesting right now. Well, it means the Fed's massively behind the curve. And we can look at continued unemployment claims. We'll talk about that data here in a bit. You see the same relationship going back to the late 1980s. We note that continued claims were rising. The Fed's raising rates here, thinking, well, this is just an anomaly. And next thing you know, as continued claims get out of control, the Fed's aggressively cutting. We see around 2000 this time, as continued claims rise, the Fed starts to get on the ball. The problem is, once again, they're too late. They didn't learn their lesson in the global financial crisis, because as continued claims bottom, the Fed believed things were going to get better. They didn't. And next thing you know, the Fed's aggressively cutting. And it's too late, because once the labor market goes, and this is the risk the Fed realizes, the whole game is over, because as people lose their job and their consumption drops, then other people lose their jobs, and it starts to snowball. It's exactly what we see in the data here. Right now, continued claims hovering just under 2 million. The Fed, as you can already see, way behind the curve. And investors are paying the most attention to payrolls again, but our attention is to wages, because they've been increasing. Now, we're going to talk about that in a moment, because this is the fixation. People think that wages matter, and they really don't get it. But I want to show you the truth behind that, because our take is that service inflation looks to be settling at a pace above what is consistent with the Fed hitting its 2% inflation target over time. That may indicate labor market inflation pressures, which make wage inflation data more important to monitor. And that's the issue here. They think that if people get raises, it magically turns into inflation, but that's not exactly the case. When we look at average hourly earnings of production and non-supervisory employees in red against the consumer price index in blue, both on a year-over-year rate of change, the concern here is what we see around 1996 is that wage growth is rising, inflation's coming down, and the next thing you know, inflation bombs and turns higher. We see that happen once again right around 2014. Inflation peaks, and then it comes crumbling down into 2015. And what happens? We see that wage growth slows a little bit, but still remains at a robust enough rate to turn inflation around. And that's what everybody thinks. If wage growth just stays up, it's going to be okay. But the problem is, we're seeing a deceleration in wage growth. We're seeing inflation come down, and yet there's no indication that wages are going to turn and go higher here. Everybody thinks they're going to, but the reality is, when you see rising unemployment or continued unemployment claims, it means there's a supply and demand mismatch for workers. There's too many workers and not enough jobs for them. So in that case, what you find out is employers don't have to give out as big of raises. They still do give out raises, but the size of them shrinks over time. And when we look at the funds rate against average hourly earnings of production of non-supervisory employees, still shown in red, what you can see is, once again, the Fed is not really a player here in terms of what's driving the economy, because what you can infer from this chart is that as the Fed cuts, is bad news for the U.S. labor market. You can see that hourly earnings decline. You see it happen once again going into the recession at the dot-com bubble, into the global financial crisis. You note again, Fed cutting rates, not good for U.S. workers. But what we're missing here is something that we're not seeing on this chart. What we're consistently note is that, again, employers still give out raises during recessions. They just don't give out as big of raises. And right now, there's no indication that wage growth is going to turn around. And if there's history as any guide here, well, if the Fed keeps cutting, that's not very good for wage growth. But let's talk about the real truth here. It's all about hours, because we've all been in this situation. We've had a job, and our employer comes in and says, hey, you know what? I'm going to give you a raise, and it's great. And by the way, I'm cutting your hours starting effective immediately. You're going to get an hour or two less a week. And so what happens on net is, while you have a pay growth that shows up in the data, hours of work goes down. So actually the worker in that case is taking home less money. And that's where we really see a factor of inflation here, because we can go back to the 1980s, and what do we see? Average weekly hours of production of non-supervisory employees is decelerating. So workers are getting less hours, and that means less income. Inflation becomes transitory at that point and comes crashing down. We see that relationship going right into the dot-com bubble. Hours worked are plummeting. Inflation rises. If workers can't afford afford higher prices. Next thing you know, we're in smack in the middle of a recession. You see that happen once again, the global financial crisis. Hours worked don't rise as fast as they have in the past. They turn and go down. Workers can't afford inflation. Next thing you know, we're right in a recession. Here you see it, the same trend. Hours worked are declining amid the fact that we're seeing pay growth still remain at relatively good levels. But it doesn't matter how high pay growth goes if people aren't getting the hours, they're not putting more money in their paycheck. But there's one way you can put more money in your pocket. We just put on a fantastic trade. In fact, we had a lot of great trades with our sponsors this week, but here's one today we put onto our CTA Timer Pro. Right now, our subscribers are sitting on 14 open trades. 9 of them are up. That's a 64% win rate as the markets are closed yesterday. Today, we gave them a fantastic trade setup. Let me show you the chart for this, because what is machine trading? What does this mean? Well, we look for when machines get in short positions and then price moves against them. And what happens, because they follow the markets, they have to turn into big buyers. And these machines trade hundreds of billions of dollars, and it can create a massive move in markets very, very quickly. So we scan this every day. We run a full back test on our reports to find out which signals gives you the best chance of making money. And here it is today, a buy it open signal, and that is going up. And here's the actual note that we gave to our subscribers. It closed over its 10 and 30-day volume profiles. Put this on your buy it open. It's on the way up. What do you get? You get the daily reports. You get all the signals. We go through and review each and every signal, give you our opinion on them, but give you the full back test data. We give you stop loss levels to help you control your risk. We track all of our trades and returns on them. We give you weekly updates on that. You even can follow my trades. You want to know what I'm trading and why? I tell you exactly that. Here's the best part. You get a 30-day free trial. You go find out what that trade is and jump in on it. As we turn to the Fed now, as Powell expects good relations with Trump administration, well, we know what that's going to take. It means the Fed's going to need to cut rates. But are they going to cut rates fast enough? Because we're already seeing signs that the U.S. economy is slowing, led by the manufacturing sector here. We're seeing hours worked get cut. We're seeing job losses in the manufacturing sector. We know that's going to turn to the services sector, who we just talked about this yesterday, is now seeing a slowdown. And all that means is, will Powell be in favor of President-elect Trump? Well, I'm not convinced, but we can afford to be a little more cautious as we try to find neutral. Well, if he says cautious, I can tell you President-elect Trump's going to want to hear cutting rates, and that's not what it means. As Powell said this in reference to the level for rates that neither spurs nor restrains the economy. But it was notable here, he doesn't actually tell us what that number is, and the reason is they don't actually know. And that's right, my friends. If they actually came out and told everyone the truth, that they don't know what the neutral rate is because there's no way to calculate it, because the federal funds rate does nothing to the economy, well, then that means we don't need a central bank, or at least not in the power that it does now. But let's take a look at those average weekly hours of production non-supervisory employee data again against the federal funds rate, and we start to see the real issue here. As incomes go down because workers are getting less hours, the Fed is cutting rates, and it doesn't actually do anything for the economy. Right now, we look and say the Fed's suggesting they need to cut 25 basis points. At least that's what the market is telling them. And yet, what is the workers saying? We're not getting enough hours. But the reality is, my friends, the Fed is likely to cut in the middle of this month, and I'll show you why. Because it doesn't matter what the inflation is. It doesn't matter what the labor market says. What matters is what the bond market is saying. And we can see a very nice relationship between 6-month Treasury yields shown in red against the federal funds rate in blue. And based on what the bond market is telling the Fed is, you need to cut, and cut now. Because things are getting worse for U.S. workers. As we turn now to the U.S. jobless claims, they rise to a 1-month high in Thanksgiving week. Notably, they say the claims are choppy around the holidays. Again, there's always excuse. Well, there's a storm. Then there was a strike. Well, now there's a holiday. There's always a reason why the economy is going to get better, but we don't see any evidence of that. In fact, what did ADP tell us? They said, look, we're seeing layoffs in the manufacturing sector. We know that manufacturers spend a ton of money in services, so as their demand goes down, their spend in the economy goes down, and the services sector follows. Continued claims are proxy for the number of people receiving benefits dropped to 1.87 million the previous week. That's nice to see it going down. Not as much as we want, despite the fact that U.S. employers have announced 58,000 job cuts in November. That's up 27% from a year earlier. Now, why aren't we seeing that in, of course, the unemployment claims? Because if these people are getting severance packages, well, that means they can't file for unemployment. But we're going to show you some other problems plaguing people on the unemployment line. And this includes ongoing staff reduction in the tech sector and the biggest round of planned dismissals in the automobile industry since April. So what we can note is what's happening in Germany. We see there, of course, our automobile sector plunging, their manufacturing sector headed into a depression, and now that's flowing all around the world. And one thing I've suggested has everything to do with the baby boomers. Remember, they're not working now, and they typically on average about 2.5 cars. I mean, now they head into retirement, they're finding out maybe they only need 1 car, maybe only just 2, and maybe one of them can be old. Not to mention, we have a lot of people working from home or on a hybrid work schedule. You don't put as many miles on your car, so you don't need to buy a new one. And now that means is people working in the automobile sector at the dealership level, at the service level, likely to find less work, and some to the unemployment line. And when we take a look at the relationship between continued claims and unemployment rate, keep in mind these are not calculated based on the same data. They just give us a perspective of what's going on here, because the experts are saying the unemployment rate stays at 4.1, and I think that's probably true, but the trajectory here suggests the unemployment rate's going to go higher, the Fed being on the wrong side of this trade. Here again, we see where the unemployment rate goes, it's falling, the continued claims higher. We see that relationship throughout each recession here, and right now the notion that we're likely to see the unemployment rate go down, to me, very, very unlikely. The problem is, as more people lose their job, particularly as we come into the final end of the holiday season. Remember, a lot of people tend to lose their jobs in January because they're seasonal work. Without their incomes powering the economy, there is a lot of risk here. But let's talk about the truth of what's going on with U.S. labor, because the unemployed for longer now clouds a resilient U.S. labor market. Well, maybe it's not as resilient as people think. The jobless rate is a little higher than a couple years ago, this is according to Fed Chair Powell, yet it remains at a very, very low level. And that's not the lived experience of the relatively small but growing number of Americans who struggle for months to find a job. Of the roughly 7 million unemployed people in the U.S., more than 40% have been searching unsuccessfully now for 15 weeks or longer, a share rarely seen until the global financial crisis of 2008. And that's what we're talking about as a real issue here, is that consumption's declining and businesses don't want to hire because they're not seeing enough demand that would give them a reason to hire. And yet the experts can't figure this out. And the share of people unemployed for more than half a year at almost 23% has been rising too. Companies aren't firing as many people, but they're not hiring either. And we know why, because when we look at demand, there's a very clear way to see it, and that is real retail sales. That's advanced retail sales less the consumer price index, shown in red on a year-over-year rate change against the unemployment rate. And what do you see as consumption slows down and then enters a contraction? What happens? The unemployment rate rises. You see that relationship every time, and right now we're nearly on the 3rd year of negative real retail sales. You want to know why they're not hiring? It has everything to do with demand, has everything to do with the fact that we're seeing those who are working, their paychecks are not keeping up with inflation. Yet, former Fed economist Claudia Saw likened the current job market to the Twilight Zone in reference to the 1960s era science fiction TV show where reality isn't what it seems. She said she could understand the lack of hiring if this were Europe, but not in the U.S., where economic backdrop is really good. Well, maybe, Claudia, it's not really good. And that's what you're not seeing here. And what I want you, my friends, to understand, that these people we put in power to make policy, they don't understand the truth. And what they are doing, why they aren't hiring more, she asked, well, Claudia, again, it's all about demand. It's all about inflation went too high. It's all about the fact that wage growth wasn't enough. There aren't enough hours. And it's all starting to snowball to the downside in a big way. And what we're seeing from all over the world is Germany heading to recession, dragging the Eurozone with it. Asia heading to a recession led by China. The U.S. following suit. And now you see why tomorrow's non-farm payroll report is going to be watched around the world as investors and political elites look to see where the state of the United States labor market is, because if it shows a soft landing, everyone's going to be excited. But if we continue to see a slowdown, you're going to watch. There's going to be panic across the board. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.